This is Macro Horizons, episode 317, Fools of April, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of March 31st. And with April Fool's Day at hand, we cannot help but wonder if Liberation Day is nothing more than an elaborate practical joke. Maybe 25% of it is? Get it? Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market retained a remarkably narrow range, all things considered. The week started with the Trump administration ostensibly backpedaling some of the more dramatic tariff rhetoric, choosing to focus on the 15 nations that the administration believes are the biggest offenders, as it were, on the global trade stage. Now, that does represent roughly 75% of U.S. imports. However, the notion that the administration wouldn't deliver wholesale across the board 10 or 15, 20% increases in tariffs did offer some solace to the Treasury market. Trump then followed up with a midweek announcement of auto tariffs, which were pretty substantial, although not necessarily unexpected. It was still an incremental bond bearish impulse, to be fair, but we didn't see the resulting price action break 10-year yields above 440 or even 450. Instead, the Treasury market appears content to consolidate in a very familiar range, that range being with 10-year yields between 425 and 435. And the front end of the market continues to be linked to monetary policy expectations. So that has provided what we'll characterize as effectively an anchor for 2-year yields at 4%. The result is that the fluctuations in duration translate into the curve being nothing more than a directional trade for the time being. For context, the Fed's latest dot plot put 50 basis points worth of cuts this year as the path of least resistance, and at present, the futures market has slightly more than 60 basis points worth of cuts reflected in pricing. Now, while we're certainly cognizant that there is a risk that a deterioration in risk assets increases equity volatility and translates through to tighter financial conditions, the reality is that the Fed's reaction function to higher near-term realized inflation will be to push rate cuts further and further into the year. Our forecast remains that the Fed's first cut in 2025 will be in September. It will be 25 basis points and followed by another move in December. That gets us to the 50 basis points that the Fed has been sticking with, and it also provides the Fed and the market plenty of time to gauge the extent to which the trade war is flowing through to the real economy. Another wild card remains the labor market. Recent gauges of the labor market suggest that the shift in federal hiring hasn't changed sentiment in the economy more broadly, and as the market prepares for the March non-farm payrolls print, we'll get a better sense as to the skew for the official BLS data. Nonetheless, it is difficult to envision a paradigm-shifting print on Friday, especially with the context of Trump's Liberation Day, in which more tariff announcements are expected, and the market will struggle to incorporate these changes into the outlook. If nothing else, these are interesting times.
Well, before Friday's core PCE update, it frankly wasn't a week in the US rates market that was especially driven by the economic data. Sure, we got some updates on consumer confidence, look at some real estate data, but generally speaking, the price action over the past week was far more of a technically driven affair with an eye on the performance of risk assets, along with, of course, the announcement from the White House of the coming implementation of 25% tariffs on cars produced outside the US, and this week's 2, 5, and 7-year Treasury supply that came and went with a bit of a concession being required for the latter two, but by no means any significant fireworks on the supply side that simply left a bearish retracement as the path of least resistance, where we saw 10-year yields break above the top of the narrow range we had been tracking, but the moves in the wake of the tariff announcements hardly represented a breakout toward material higher yields, and instead, conviction among market participants remains unquestionably light as the outlook remains murky, the Fed has affirmed that they are in a great hurry to do nothing, and we wait for next week's payrolls report now that core PCE for February is in hand.
One of the things that the market spent a fair amount of time doing in the week just past was calculating how much core PCE will increase as a result of the tariffs. Now, there are a wide variety of estimates, and the back-of-the-envelope calculations imply that there will be higher realized inflation in 2025. However, given Powell's characterization of tariff-related inflation as transitory, it won't necessarily have the same implications for monetary policy. To be fair, delaying cuts seems to be the hawkish default for the Fed at the moment. So in the event that the next several weeks reveal more on the tariff front, both from the U.S. as well as responses on the other side, one should expect that the conversations about resumed normalization will be moved later into the year. Now, as you point out, Ben, we haven't seen this translate into a wholesale sell-off in the Treasury market. And in fact, at this stage, we doubt that that will be the ultimate outcome from the trade war. Instead, the market's focus has shifted toward the growth implications from a trade war and what higher prices will mean for the pace of consumption and the willingness and ability of households to continue driving the U.S. expansion. Now, in light of the advanced goods print that we just saw for February, we're increasingly concerned of the drag from net exports on the overall growth profile. The big question isn't whether or not net exports will be a drag in Q1, but rather whether that will be given back in Q2 and Q3, or if the trade war will ultimately result in a shift lower in demand for U.S. goods abroad. It's certainly a risk, and it's one that we'll be watching play out over the course of the next several quarters.
And in contemplating the growth outlook, and in addition to what we've talked about in terms of the risks facing consumption, along with the net exports component of GDP, one of the unifying themes in our conversations with clients this week has been this idea that as the dust has settled in the wake of the FOMC, really one of the bigger takeaways from what we learned from Powell, given the broader uncertainty, is that upside risks to inflation, as you touched on, Ian, have increased, and downside risks to growth as a function of uncertainty or as a mathematical result of the shift in net exports is going to mean that the Fed is again faced with the predicament of having to choose between the inflation side and labor market side, or shadow growth side, of the dual mandate in terms of setting the appropriate level of policy. Now, even though the median dots in the dot plot were not unduly hawkish, on a compositional basis, the shift higher, especially in the 2025 collection of forecasts from monetary policymakers, suggests that from the committee's perspective, the ability to continue containing inflation and continue reinforcing the central bank's credibility as an inflation fighter is still going to outweigh the Fed's endeavors to avoid a recession, or if not technically a recession, a lower growth regime going forward. It's a cost-benefit conversation, and clearly as the risks around core inflation have started to shift back toward the upside, the price that Powell is willing to pay to prevent a reacceleration of inflation may indeed come in the form of a dimmer growth outlook or even materially softer labor market regime. And we'll argue that's why, despite all the reflationary angst, we still have 10-year yields sitting between 4.25% and 4.5%, and not much closer to 5%.
And that does beg the question, what's the next level for 10-year yields? Are we going to see a dip below 4%, or are we going to see a move back above 4.60? Now, all else being equal, One would expect that as the labor market data continues to demonstrate the resilience that has characterized much of this cycle, that the market's focus will shift back to any inflationary angst and put upward pressure on longer-dated yields. However, as you point out, Ben, the risks associated with the labor market, the consumer, and the general trajectory of growth have capped the extent to which yields have been able to back up. Our approach to Trump's so-called Liberation Day is that we expect that the peak bond bearishness of the event will occur in the run-up to the actual announcement, i.e. a classic sell the rumor, buy the fact in the Treasury market. This implies that the market is already trading off of the worst-case scenario for Trump's latest round of tariffs. Now, of course, the uncertainty around the situation has only been extended further by the fact that the April 2nd announcement of new tariffs will not be the final increase in levies by the administration, although we would like to assume that once we are through the week ahead, that the market and the Fed and the administration and the economy more broadly will be operating under the impression that we're at least in the second half of the trade war.
And at the risk of redundancy, a point we've made before, it's not necessarily the tariffs themselves that are having the greatest detrimental impact to the outlook for the economy, but rather the volatility and uncertainty around those tariffs and what that means for businesses and households' ability to plan, make business decisions, hiring plans, investment in infrastructure, and the list goes on. And in a conversation with an especially astute client this week, and piggybacking off the point you just made, Ian, once we get some sort of clarity and stability around the new trade regime, there is the potential for a more textbook reaction to what, remember, was still a red sweep at the November election to allow the more traditional pro-growth impulses associated with the policy agenda in Washington to begin to make their way through to the economy. The easy examples in this regard are the deregulation story, a boost in investment from easier credit conditions, perhaps an increase in productivity as a result of some of the reshuffling in the labor market. And while at present all of these factors have been unquestionably overshadowed by tariffs and what that means for the international trade landscape, once there is a degree of stability, not necessarily no tariffs, but rather stability around tariff policy, it's at that point that investors will be eager to see what other policies, away from just import taxes, will be coming from the new administration and how those policies could potentially impact the outlook for growth and for the level of yields.
Also within the price action, it's been notable that we have seen an extension of the curve steepening that many anticipated would define 2025. Although, to be fair, many also anticipated that it would define 2024. Nonetheless, 2s, 10s, and 5s bonds continue to push higher, and this is a move that we expect has further room to run. In 2s, 10s, a breakout to 50 basis points seems the path of least resistance, and we would expect that that will be a bull steepening driven by the front end of the curve as opposed to a bearish repricing further out the curve. One of our near-term concerns as it relates to the steepener is this notion that the market has, to a large extent, fully priced in a dire outcome from Trump's Liberation Day, and once we have the details in hand, we would expect a stabilizing bid to emerge in the Treasury market. The risk as we see it is that this stabilizing bid favors duration, i.e. 10s and 30s, over the front end of the curve, momentarily stalling some of the steepening that we expect will continue to drive the market over the coming months.
And there's been one dynamic that's taken a backseat in the conversation that we've been having today and, frankly, over the past several weeks, and that is that the role that Treasury supply has been having in the shape of the curve has now taken a backseat in favor of the outlook for inflation and the path of the economy. Obviously, around the election, there was this idea that a massive increase in deficit spending would translate to the necessity for the Treasury Department to increase coupon auction sizes sooner rather than later. Instead, what we've seen is that there's a much more measured approach to increasing auction sizes, and instead the priority has been on cost-cutting from the new administration. And particularly as we saw the reaction in the gilt market this past week to the latest update on the UK's issuance plan, the steadiness of term premium from the supply side in the U.S. serves as a reminder that while there's certainly plenty of conversation to be had about what the political changes in Washington mean for the dollar's role in the global financial system, at the present time and for the foreseeable future, treasuries will not suffer from the same supply-side angst as other sovereign asset classes, with gilts the latest example this week. But let's not forget the moves in Germany a few weeks ago and the other episodes of supply-driven bearishness in sovereign debt markets.
So what you're saying is that treasuries are special after all.
In repo?
Don't do repo. In the week ahead, the Treasury market will have the input from the fundamentals in the form of the March non-farm payrolls print. Now, expectations are for 150 to 160,000 jobs having been created during the month, and that's a solid print in light of all of the uncertainty that there is in the real economy at the moment. The unemployment rate is seen as unchanged, and while there has been a fair amount of fluctuation with the labor force participation figures, we expect that they will be stable in the month of March. Now, it will also be notable to see how the market chooses to trade the JOLTS data, which is February information, combined with ADP, Challenger, as well as jobless claims. Recall that the Challenger numbers showed a spike in layoff announcements that didn't ultimately translate through to the BLS data in February. It'll be interesting to see the degree to which the Challenger release drives price action. It did last month, and it certainly could again in the week ahead. Now, beyond the fundamentals, however, the market will have the Liberation Day tariff announcements from Trump. There are a wide range of expectations and potential outcomes. We continue to view the event as being fully priced in, which implies that once the market does have the details of the new tariff regimes in hand, that we'll see a stabilizing bid emerge in the Treasury market. We also expect that positive sentiment will be evident in the equity market as well, and anticipate that risk assets will perform reasonably well, all things considered. This does present the risk that any risk-on move in the equity market translates through to higher yields simply as a reverse flight to quality move. Setting that risk aside, we do anticipate that the net takeaway will be positive for both bonds as well as risk assets in U.S. equities. In light of this backdrop, we are wary that our curve steepening bias will be put on hold with the tariff announcements, the assumption being that what comes out of the White House won't materially extend the steepening, but instead provide a bit of solace to the broader market, which will result in a flattening impulse. Albeit a temporary flattening impulse, but nonetheless an offset to some of the pressure recently seen in U.S. rates. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. As the market once again prepares to run the gauntlet of employment proxies, we're reminded that nothing trades better than positive carry feels. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/macrohorizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.